The word debt can elicit either sense of fear or a sense of hope in different individuals. The difference is between a good debt and bad debt. What are these? Let's find out. The good debt, it is an investment in the future. Think about student loan or a business loan or a mortgage where the value of the property is expected to rise. Now that is a good debt because here you're investing in the future. Here usually the rate of interest is also low and is also more secure. It's like planting a seed which will grow into a tree in the future. Bad debt is, on the other hand, basically a liability where you put in money for the value of something that is decreasing or remaining stable, or it's just a consumption. For example, your credit card debt. If you are exceeding your limit on credit card, or if you are not paying it on time, and the interest that you're paying on the credit card is very high, it's very bad debt. The investing in or buying a very expensive car. Now there the value is also falling. That means that if you're doing that on loan, then that is also a bad debt. Other buying any valuable items which the value is not going to increase, that is a bad debt. So our strategy has to be to increase good debt and reduce bad debt. Because without debt, without leverage that they call it in the financial world, you're not going to grow. It does not matter how much money you earn monthly or yearly if you're a big shot professional, very high income earner, but still if you don't have leverage, you don't use other people's money, if you don't use other people's means the bank's money, then the growth prospect is going to be less. That's why one has to find places where, or the opportunities where you could use loans from the bank and grow your value, grow your worth. Now, this is a kind of good debt. So our aim has to be to increase good debt. And the bad debt has to be paid off. Now, how do we pay off, or what should be the strategy? There are basically true strategies about that. One is called the avalanche method. Avalanche method is that the pay off the debt which is the highest interest rate debt. It's also my favorite because it makes sense that where you're paying more interest, you pay that off. Other, the snowball method. That means where you pay off the small amount, irrespective of the interest rate, the amount which is small, that you pay off first. That means your number of loan reduces. Another way to go about it is you have to combine the loans, restructure it, and try to get the lower, the middle rate for some loans so that the number of loans are less. That is also one way to give you a psychological relief. Imagine a life where you are not chained to the monthly EMIs, where if I have to think that, okay, every month I have to pay $3,000 for the EMI to the bank, that means I have to calculate my living expenses, for example, $4,000 plus the EMI that will go for a home loan or whatever loan, $3,000, total $7,000. That means I cannot take up a job, I cannot take a vacation, or vacation means a sabbatical, I cannot take anything else which pays me less than $7,000 a month. I'm chained to that $7,000. That means now I'm not working for myself or for my independence. Now I'm working to pay off that loan. That is not a very good state to be in, which most of us are, unfortunately. Our aim has to be that the freedom, the financial freedom, means you are financially free. You're not chained to any work. You work because you want to work. You're interested in the work that you're doing. That's why you work, and not because you. So that is the goal, my friends. Like and subscribe to this channel, and we'll talk about these things in the future as well. And if you have doubts, questions, or suggestions, I'm no financial expert. I'm just sharing my thoughts and opinions that I have learned over the period of time. If you have better ideas, do let me know in the comment section and we can have a discussion about that. Have a nice time.